Hi everyone, I am Manoj Dirasinghe and today we will be doing a quick revision of chapter 1 from your syllabus. This chapter covers Introduction to Management Accounting, relevant cost, and decision making under risk and uncertainty. For this session, I'll be using the study pack published by the AAT Sri Lanka. However, don't worry if you don't have purchased the study pack or if you don't have a copy with you now, because we will be displaying all the necessary theory sections during this video. So you can take a screenshot or just write down any important points as we go along. Okay, let's get started. Okay, chapter number 1, Introduction to Management Accounting, relevant cost and decision making under risk and uncertainty. Right. 1.1, what is management accounting? Actually, I'm not going to take too much of time to explain theory parts, but you have to by heart or memorize some certain definitions, because in your examination, up to 3 marks, it can be tested regarding the theory parts. Okay, so and this question, what is management accounting, is also playing an important role. So you just by heart what is management accounting, just a small definition in your words. It's okay, you don't need to give the exact words in the study pack gives, right? In your words, just memorize a small para regarding what is management accounting. As well as, if we quickly move to 1.2, difference between financial accounting and management accounting also plays a important role in your examination, right? It also can be tested. Best thing is, at least 3 points you have to memorize, you have to by heart, right? So memorize three parts or 3 points to, to answer the difference between financial accounting and management accounting. In this case also, I'm not wasting time. I'm moving to point number 1.3. Next point, importance of management accounting. Same here, they have to memorize at least 3 important points, right? Okay, we are moving to next part, 1.4, preparation of financial statement under marginal and absorption costing method. In this case, I'm taking a little bit of time to explain what is marginal cost and absorption costing method. These are two different costing methods, reporting methods. Okay, first start from the absorption costing. Absorption costing techniques absorb fixed overhead or fixed production overhead into your products. Let's say, as an example, if we are paying 100,000 as our fixed production cost for a month, and we are planning to produce 20,000 units in a month. Under the absorption costing method, we are absorbing this fixed cost into a product like this. 100,000 per month is the cost, and we are planning to manufacture 20,000 units. So we divide 100,000 by 20,000 units, and we'll get 5 rupees per unit fixed cost. We call it as absorbed cost per product is 5 rupees. But in these techniques, you have already studied in your level 2, right? We are recording each and every product we have produced from the day one, we are recording in our books, fixed cost is 5 rupees. Actually, but we know, fixed cost we don't incur in terms of units, right? It is fixed for a period. So if it's 100,000 per month, it is fixed. It may change, but not due to number of unit produced. It may change due to various other reasons, inflations or capacity change, some other reasons, but not because of the number of units we produce, right? So under this absorption costing method, we absorbed estimated fixed cost because we haven't incurred it yet. At the beginning of the production period, we haven't spent the fixed cost, but we are estimating it for the next period. So we are estimating 100,000 for the next period, next month, as well as we have to estimate the production in order to absorb the cost into a unit. So we are estimating we will produce 20,000 units. Then we identify a unit fixed cost is 5 rupees. That's what we call absorb fixed cost per unit. So we are taking into account when we are producing from the day one, 5 rupees into number of production as our fixed cost, right? As our fixed cost. Let's say on 20th or 22nd day of the month, we have finished producing 20,000 units. We have reached the production level to 20,000 units. And there are more orders, more demand for this product. We are not going to stop our production. We don't say, hey, we have estimated only 20,000 units. So we have already produced the 20,000 units. So no more production. We don't say like that. This is not a government organization. Some government organization people will say like that, right? But not in the private sector. So we don't stop production. We will keep on producing and selling if there is adequate demand. But we have already recorded 5 rupees per unit as the fixed cost because initially at the beginning we assumed only 20,000 units will be produced. Based on that estimate, we identified 5 rupees as unit production cost, but we are recording it into books. With each and every production, we are recording the cost in our books. What we call it as absorbed fixed cost. So absorbed fixed cost can vary, or there can be a difference between the absorbed fixed cost and estimated fixed cost. So what will happen if we produce 30,000 for this month? At the end of the month, we have absorbed 30,000 into 5 rupees. That means 150,000 as our fixed cost. We estimated only 100,000, but we have recorded the absorbed fixed cost as 150,000. Why? At the beginning of the period, we didn't knew that production will increase up to 30,000. We only expected it will go up to 20,000. And at the end of the period, when we are paying the fixed cost, building rent won't change due to increase of the production. Fixed salary won't change due to increase of the production. None of the fixed cost change just because our number of production is increased. So we are only paying 100,000. Let's assume there's no other reasons to increase the fixed cost. So we are paying only 100,000. But we have absorbed 150,000. So at that time, we are facing over or under absorptions at the end of the period. So let's see. That is the absorption costing method. But when it goes to the marginal costing method, I'll explain that as well and come to the theory part. So when it comes to marginal costing method, it clearly says we cannot absorb fixed cost into our production because fixed cost is fixed for a period. It won't change with the production number of units. So how come we identify a fixed cost per unit? It is, I mean, it's not practical, it's not logical. That's what relevant marginal costing method says. That's what marginal costing method says. It is not practical, it's not relevant. So it says we will identify only the variable cost, marginal cost of a product as a unit cost. And we will cover up all the fixed cost by using our revenue. Right? That's what marginal costing method says. Okay, we'll start from the marginal costing. Come to the study pack. We are moving page number 5. So actually this marginal costing method and absorption costing method, under these two methods, we have already studied in level 2 how we are accounting them. In this level 3 management accounting subject, we are discussing only the profit statement under these two scenarios, two costing methods. So we'll discuss how we prepare the profit statement under marginal costing method. So marginal costing method, we are taking the sales value and deducting variable cost of sale, deducting all the variable cost from the sales value. When we identify the variable cost, we identify variable cost of sales. You know the word of cost of sales. How many costs we have incurred for the number of units we have already sold. How we calculate the cost of sales? When in financial accounting, we take opening stocks. We add purchase cost or manufacturing cost. And we deduct closing stocks and we get the cost of sales. The same thing here, but under marginal costing method, we are identifying variable cost of sales. How? We get the opening stocks valued at variable production cost. Valued at variable production cost. And we add variable production cost of the period. Again, we are deducting closing stocks valued at variable production cost. Then we will have the answer for variable production cost of goods sold. For this variable cost, we'll add if there is any more variable cost in our organization. Let's say variable selling and distribution cost, variable administration cost. If they are available, we add them also. And now we have total variable cost of this organization for a certain period, specific period. So from the sales value, we are deducting those total variable costs and we will have the answer of total contribution. What is this total contribution? Total contribution means from the sales value, if we deduct all the variable cost, we will have the contribution. Contribution means this value contribute to recover the fixed cost. we discussed earlier, under the marginal costing method, we have to recover our fixed cost by using the revenue. But revenue itself, the total figure, don't give us a room to cover the fixed cost, because we have to spend some variable cost to get this revenue. Let's say if we are selling a product at 100 rupees, total 100 rupees we cannot use to cover the fixed cost, because why? We have to purchase this product or manufacture that product to sell it. So to manufacture or to purchase, let's say we are spending nearly 60 rupees as a variable cost. So that variable cost goes away. I mean, we can only retain from the sales price of 100 rupees only 40 rupees after deducting the 60 rupees variable cost, because variable cost we have to pay. Then that 40 rupees balance we can utilize to cover our fixed cost. That 40 rupees we say, we label it as contribution. Contribution. So from this contribution, total contribution, we are deducting fixed costs. How many fixed costs we have? Production fixed cost, selling and distribution fixed cost, administration fixed cost. After deducting all the fixed cost, if something we receive at the end, we call it as net profit. So we can use it for our own benefit, because we have already paid all the expenses we have to pay. So this is the format of the profit statement under marginal costing method. And there's an exercise. Let me read the exercise for you. Nuwan Limited is producing one product and selling it for 50 each. There's no closing stock at the end of May, and information related to the months of June, July, and August are as follows. Standard variable cost per unit: direct material 18 rupees, direct labor 4 rupees, variable overhead 3 rupees. Estimated fixed production overhead cost per month is 99,000. Budgeted fixed sales overhead cost and fixed administration cost per month are 14,000 and 26,000 respectively. There is no difference between the budgeted cost and the actual cost in the month of June, July, and August. Variable selling cost is 10% of the sales value. Average production capacity per month is 11,000 units. Production and sales data for the month of June, July, and August are as follows. June, July, August. June, production 11,000, sales 11,000. July, production 14,000, sales 12,800. August, production 10,200 and sales 11,000. Can it be happen? If we produce only 10,200, how come we sell 11,000? Yes, it can. How? When you move to the July, month of July, you see the production is 14,000, but they sold only 12,800. That means 1,200 number of units are kept as our closing stock in July, month of July, or didn't sold out during the month of July. So it remains in our stock. So with that 1,200, in month of August, we are producing another 10,200. Altogether, we have 11,400 units. From that 11,400, we are selling only 11,000 units. That means even after selling 11,000 units in August, we will have 400 units as our closing stock for the month of August. So you are required to prepare the profit statement for the 3 months under marginal costing method. I'll quickly show you the answer as well. So you can have, you don't need to prepare 3 statement. You can have just 3 columns: June, July, and August. Every month you should have 2 columns separately. So this is the answer. So again, we are moving to the next section. Profit statement under absorption costing. We discuss it. Absorption costing means we are absorbing fixed overhead, fixed production overhead into units. So under this method, look at the format. Profit statement, marginal, actually it's not marginal cost. It is absorption cost. Right, there's a small printing mistake. So sales value. From the sales value, we are deducting the cost of sales. Cost of sales we know how to get. Opening stock plus variable production cost plus overhead cost absorbed. This is the difference of the statement from accounting perspective to management accounting perspective. I mean, when you're preparing profit statement under financial accounting, right, whatever the amount you paid or payable are identified as the production overhead. But in this management accounting techniques, when we discussing absorption accounting method, we don't write or we don't identify the fixed cost we have already paid in our statement. What we are doing is we are taking the absorbed fixed cost, absorbed to accounts. How we absorbed it? Number of unit produced multiplied by unit fixed cost estimated at the beginning, or unit fixed cost absorbed at the beginning. That's what you call overhead cost absorbed, and deducting the closing stock. All the stocks are valued at total cost here under the absorption method. Then we get the gross profit. But to that gross profit, we have to adjust over under absorption. If it is over absorption, we have to add. If it is under absorption, we have to minus. Then we are deducting the administration cost, all the variable and fixed cost. Sales and distribution cost, there again, variable and fixed cost both we are deducting, and we will have our net profit. We will have our net profit. So same exercise we are preparing under the absorption costing method. Look at the answer. Sales value, cost of sales, here the total cost per unit is 34 rupees. 25 rupees variable cost plus 9 rupees fixed cost absorbed. And the variable production cost. Absorb overhead. How we calculate? 9 rupee per unit into unit of production. Number of unit produced. During the June, 11,000 unit produced. 11,000 into 9, 99,000. During the July, 14,000. Produce 14,000 into 9, 126,000. Right. This is the absorption rate calculation. Budgeted total overhead cost is 99,000. We are taking only the production overhead, right? And budgeted number of units 11,000. Why we are absorbing like this? I have already explained. At the beginning of the period, we don't know or we don't have any clue about what is the actual production. At that time, we believe that we will produce 11,000 units, but actually it changed, right? But at that time, we only knew these two figures, estimated fixed cost and estimated number of units. Using these figures, we have identified 9 rupees as the unit production cost absorbed. Over under absorption, it's also very important. When it comes to month of June, the absorbed overhead cost is 99,000. 9 rupee each into 11,000 units, 99,000. Actual cost is also 99,000. Question says actual costs don't differ from the estimated cost. And in this month, estimated cost also 99,000. So there is no over under absorption. But when we move to July, month of July, absorbed cost is 126,000. But actual cost is 99,000. And in this month, estimated cost also 99,000. So over or under absorption, we are calculating, we are taking the difference between absorbed overhead cost and actual overhead cost. We don't take into consideration about the estimated overhead cost. So over under absorption means absorbed overhead cost and actual overhead cost. So in this case, month of July, 126,000 is the absorbed overhead. Still the 99,000 cost is the actual cost. So 27,000 is the difference. August, 91,800 is the total cost. Absorbed cost. Actual cost is 99,000. So 7,200. There's an under absorption. Under absorption. So when we move to the 1.5, comparison of profit under marginal costing and absorption costing. Did you see this difference? Did you observe this? Look at here. Month of June, the profit under absorption costing is 81,000. Month of July, profit under absorption is 127,800. This is under absorption costing. When it comes to marginal costing, month of June, profit is 81,000. But July, profit is 117,000. Did you see the difference? Month of June, under absorption or marginal costing, profit is same, 81,000. But month of July, under absorption costing, it is 127,800. Under marginal costing, it is 117,000. It's 117,000. What is this difference? Same business organization, same set of information. There's no difference between these two exercise. There's no difference between the numbers of these two exercises. But why the profit varies from one to another? This is in here 117,000. In here 127,800. The reason is the absorbed fixed cost is transferring with the closing stock. See the difference between the two closing stocks here. Under absorption costing method, 40,800 is the closing stock. Under marginal costing method, closing stock is only 30,000. Closing stock is only 30,000. That means there's a difference between 10,800. That is the difference between two profit figures. If we add 10,800 to 117,000, the answer is 127,800. That is the answer in the absorption costing method. So this different comparison we are doing from the marginal costing and absorption costing. Okay. And sometimes this comparison also tested in your examination, but most of the time you will get a profit statement under marginal costing method. You will get a question like this: prepare a profit statement under marginal costing method. Okay, we are moving to our second area, relevant costing techniques. Relevant costing techniques. Principles in relevant costing. So actually this relevant costing techniques or principles we are using when we are taking a short-term decision or under the short-term decision making. This is not regarding a long-term decision or an investment appraisal. This is about the short-term decision making. How we are identifying what is the relevant cost and what is not. Right? Under this, right, we'll move to 1.6. Principles in relevant costing. Relevant costs are the costs incurred for the purpose of specific management decision. Costs incurred for the purpose of specific management decision. Right? It represents the future cash flows and the importance of it is determined based on the result of the management decision taken. One or few of the following features can be identified in the relevant costing based on different situations. You can identify one or few of the following qualities in a relevant cost. Let's say how we have, let's discuss how we are identifying whether a cost given is relevant to our decision or not. Right? It should be a future cost or a cash flow or an incremental cost or cost which can be saved or opportunity cost. One or few of these qualities can be identified from a relevant cost. Let's move to the future cost. What is future cost? Future cost doesn't mean that cost we are incurring in future, right? Cost which we are incurring in future also future cost. But when we come to the relevant costing techniques, future cost means cost which we are incurring in future because of a decision we are taking now. If you don't take decision, that cost will not occur in future. Right? Let's say we are manufacturing garment items. We received an order from a client to manufacture 1,000 units. We have to purchase a new clothes materials, garment materials in order to fulfill this order. So the material purchasing cost is relevant for this decision. Because if you take decision to manufacture this 1000 number of units or accept this order, we have to incur additional material cost to purchase this specific material for this order. So it is a future cost. The second thing is cash flow. The non-cash expenses or notional expenses or estimated expenses, we don't identify them as relevant costs. That's why we are not absorbing the fixed cost as well. Fixed cost, you can remember, fixed cost initially we are estimating. Estimated costs are not cash flows. We didn't spend. We are not paying that amount. We will be paying a different amount as fixed cost, but not the estimated amount. The actual cost can be vary from the estimated amount. Therefore, we are only taking into consideration cash flows. The cost should be a cash flow. Cash flow means we have to pay or else we can save some spending. Next thing is the incremental cost. That means there can be cost which we are already bearing or which we are already paying. But because of a decision we're taking, if we have to increase the payment, that incremental part is relevant to our new decision. That incremental part relevant to our new decision. Cost which can be saved. Other side of the incremental cost. That means we are spending a certain amount of cost for an item now. But when we are taking the decision in future, we can save up to 30%. We can save up to 30%. Let's say we are running a restaurant. We are preparing French fries. Now what we are doing is we are preparing French fries using vegetable oil. Right? But we are going to change the technology. We are going to buy air fryers to manufacture the French fries. Then with this decision, we don't have to purchase cooking oil anymore, because in air fryer or even in an oven, microwave oven, we can manufacture French fries without cooking oil. So we can save the cost of purchasing cooking oil if we take the decision of purchasing an air fryer. So cost which we are saving by reducing the purchase of cooking oil is a benefit to decision that we took to purchase an air fryer. Okay, the opportunity cost. Opportunity cost you have studied even under your economic subject. So what it says, opportunity cost is if when we are selecting one alternative, the amount we are sacrificing from the next best alternative is our opportunity cost for the selected decision. What it says, which we are sacrificing the best value from the best alternative we have. We consider it as opportunity cost. So when we move to the non-relevant cost, the cost which we are not suitable for the management decision, which means cost which cannot be changed due to the management decisions are called non-relevant cost. That means even if we take a decision, or even if we not take that decision, we cannot change this cost. So those costs are non-relevant. Let's say an example. We have a permanent staff. We are paying 20,000 rupees per month as the labor cost, fixed labor cost. We are getting a new order to manufacture. Let's say we are in a we are doing a garment factory, 1,000 t-shirts for a school. For that, the management decide we don't need to hire new staff members. We can use the existing staff members because we are running under capacity current now. So just because we are running under capacity, what we are doing is we are utilizing that under capacity to manufacture this product, 1,000 number of units, 1,000 number of shirts. So then labor cost is irrelevant to this 1,000 number of units. Why? Even if we didn't take these decisions, permanent staff, we have to pay 20,000 per month. Even we take this decision, the amount, the figure won't change. Still the same figure, same amount, we have to pay 20,000 units. Even if you don't produce anything, you have to pay 20,000 because they are fixed labor, fixed salary we are paying. Okay, what are the characteristics of non-relevant cost? Sunk cost, or we call it as historical cost as well. Past cost, also we can say. Committed cost. Committed cost means, I mean, it may not be paid yet, but in future we may have to pay it, or we will pay it. But even still, it is not relevant for our decision. Why? It is committed by an agreement. Even, I mean, we didn't take this decision, we have to pay that cost because of our agreement. Then it won't change because of our agreement. Then we say that those type of costs are committed costs, they are not relevant. Finally, absorb cost, overhead. Absorb overhead, we calculated using estimated fixed cost, which is not a cash flow. So absorb overhead are not relevant when we take this short-term decision making. So let's we move to this exercise. Identification of relevant cost. Amden Company Limited is agreed to pay 22,000 to Simon to get a special activity. The information on the materials required for the said activity is as follows. A, B, C, D. Type of materials. There are 4 type of material, A, B, C, D. There's a small printing mistake in this study pack. So correct this. This 1,000 number of unit is not stock, available stock. It is the required quantity. Under material A, required quantity is 1,000 number of units. Available stock 0. Therefore, purchase cost of the stove is 0. Stock value it is not the stock value. It should be market value or the market price. It should be market price. Okay, we have to do some corrections actually. Market price is mentioned here. Realizable price is this one. That means our current stock we can realize at this rate, but the market price when we purchasing from the market, this is the cost, right? There's a small printing mistake, please correct that as well. So type A 1000 stocks we need. We don't have any available stocks in our stores, so there's no purchase cost, there's no realizable value, but market price is 6 rupees per unit. When it comes to type B, we need 1000 units for the production, but 600 units are available in our stores. Those 600 units we have purchased by paying 2 rupees per unit. But now we can realize this 600 unit at 2.5 or 2 rupees 50 cents. But if we are purchasing new type B units, the market price is 5 rupees. What is the difference between the market price and this realizable value? This realizable value means the second hand market price of these stocks. So stocks in hand can sell at the second hand market price 2.5. But when we are purchasing brand new, again, we have to spend 5 rupees. When it comes to the type C, 1000 stocks we need, 700 units we have with our stocks. Those 700 units we have purchased at 3 rupees, but now the realizable value is 2.5. The market price is 4 rupees. When it comes to the product D or material D, 200 units needed for this production. All 200 units are available in the stocks, which we have purchased by paying 4 rupees. Now those stocks can sell at 6 rupees per unit at the second hand market. But if we are going to purchase it brand new, we have to pay 9 rupees as the purchase cost. So it says raw material B is used by the company for its daily activities, and when the stocks are issued from the stores, those quantities need to be produced for the stores. That means we cannot take material B available stocks from the stores. For a temporary purpose we can take, but if we take it, we have to reproduce or we have to refill the available stock. But it says since C and D have been purchased already in excess, there is a surplus in those stocks. C and D are different story. C and D available stocks in the stores are free to use. We don't need to replace them, right? Those are purchased before earlier, and there's a surplus. That's why it's in the stock now. But C cannot be used for any other activity. C cannot use for any other activity. And D, small correction, make the correction. And here, D stock, not just D. D stock can be used instead of 300 unit of E to complete another activity. So for another activity, we need 300 unit of E material, which we are not using for this production. But we can use 200 unit of D stock as a substitute for the 300 unit of E. So there's another use, right? And it says 1 unit of item E can be purchased at cost of 5 rupees. So you are required to calculate the relevant material cost in accepting this order. Right. So we'll move to the answer as well. Look at here. Number A, item number A, 1000 units we need. We have to buy it from the market, so 6 rupee per unit, altogether 6000 rupees. When it comes to item B, 1000 units we need, only 600 in the stocks. That means 400 units anyway we have to purchase at the rate of 5 rupees. So 400 units at the rate of 5, 2000 rupees. But it says B is used by our production, daily activity. So if we use the stocks, we have to replace them. If we use the stocks, we have to replace them. This 600 also, we have to purchase it from the market. Because why? If we are using this 600 number of units from our stocks, we have to replace them now. To replace them, we have to purchase it from the market. So anyway, even the 600, we have to purchase at the rate of 5 rupees. So total cost is 5000. When you come to C, we need 1000 units, 700 units in our stocks. That means 300 we have to purchase from the market. 300 at 4 rupees. But in this case, this 700 number of units available in the stocks are free to use. There's no other alternative, as well as we don't need to replace them again. Then this 700 number of units we have already purchased some other day, purchased at 3 rupees per unit. That means 2100 is the purchase cost of this 700 number of units. But we don't consider that 2100 rupee cost as a relevant cost, because it is a sunk cost. We have already purchased, over purchased, and no use, no alternative use. So we can't change this purchase cost 2100 even if we not used this stock to our special project. So this purchase cost 2100 is irrelevant for this decision. But there is opportunity cost. We can sell this 700 unit at 2.5 and realize 1750. But if we use this 700 unit to our this production, to our this project, we have to sacrifice that 1750 rupees. it is a opportunity cost. It is an opportunity cost. So we are taking that opportunity cost into consideration. Therefore, the relevant cost for material C is 2,950. When it comes to material D, 200 units we need, 200 units we have in our stocks. That means we don't have to purchase it from the market. So we are not purchasing at 9 rupees. But this 200 number of units have purchased at the rate of 4 rupees. That means 800 rupees we have spent. That cost is irrelevant because we cannot change that cost even if we don't use this material to our new project. Therefore, the purchase cost is irrelevant. But there is an alternative uses. There's an alternative use. There's opportunity cost. One use is we can realize the stock at the market, second-hand market, at the rate of 6 rupees. At the rate of 6 rupees, 200 units we can realize. We can get 1,200 rupees. But you remember, question says D can substitute 300 unit of E. D stock can be used instead of 300 unit of E. That means another alternative is there. Without selling it to second-hand market, we can use this D stock. That means 200 unit of D we can use as a substitute to 300 unit of E. That means we can save 1,500 rupees. How? To purchase 300 unit of E, we have to spend 5 rupees each. 5 rupees into 300 is 1,500. You have to spend. Now we can save that. Now we can save that. So there are two alternatives. We said opportunity cost is the value of the next best alternative, not the value of all the alternatives. So what is the next best alternative? We have two alternatives. We can sell this D stock at the second-hand market and take 1,200, or else we can substitute this 200D into 300E and save 1,500. What is the best alternative? Saving 1,500 is the best alternative. The highest value we enjoy. So 1,500 is the relevant cost for material D. Okay. Right. Then we are moving to our next part, cost, volume and profit analysis. Cost, volume and profit analysis. For this, using my own example, let's say we are producing an item called X. We are producing an item called X. We are selling that. Selling price, SP means selling price is 100 rupees. And the variable cost for production is 40 rupees. So once we incur the variable cost from this 100 rupees, we are enjoying 60 rupees as our contribution. This is the contribution. Why we call this as a contribution? Because this amount is contributing to recover our fixed cost. Let's say our monthly fixed cost is 6,000 rupees. That means we can cover our fixed cost by selling X units, but from each and every unit we will receive 60 rupees only to cover this fixed cost. Why? We are selling it at 100 rupees, yes, but we have to purchase it. Let's say we are purchasing some goods from PETA and selling it in Maradana or selling it in Colombo 3, right? We are selling at 100 rupees, but we have to purchase it at 40 rupees. So this we call contribution. So I'm going to discuss with you few concepts under this profit volume part. First one is the CS ratio. We already know the contribution is, so CS ratio. What is this CS ratio? From the name you can understand. Contribution, sorry, it should be CS ratio, not SC ratio. Contribution to sales ratio. That means the ratio between the sales value and contribution. How we are going to calculate it? We are taking contribution divided by sales into 100. Contribution to sales ratio. This is how we calculating it. When we move to our example, what is the contribution to sales ratio? Our contribution is 60 rupees divided by 100 into 100 60%. The second part I'm discussing break even point. What is this break even point? Before I'm discussing the break even point, what is meant by break even? Break even means a level where that company or a business enjoy no profit, no losses. The level where there are neither profit, no losses. That means the level where we fully covered our all the cost with our sales value. At this point, we says our total contribution is equal to our fixed cost. Right? At this point, we says our total contribution is equal to our fixed cost. Right? Why? Contribution is the thing contributing us to cover our fixed cost. So if we manage to cover fully our fixed cost, that means our total costs are covered. How? From the sales value, anyhow we are covering variable cost. After covering variable cost, we calculate the contribution. From the contribution, from the total contribution, right? if we manage to cover the fixed cost as well, then our total cost will be covered. At that point, we don't have any losses nor any profit. Right? Okay. At this point, we are identifying break-even point in two ways, which are break-even point units, break-even point in rupees or in value. Break-even point units means how many number of units we have to sell in order to enjoy no profit no loss status. What is the number of unit we need to sell? Let's take this example. Our fixed cost is 6,000 rupees. So our fixed cost is 6,000 rupees. From a unit, we will only get 60 rupees to cover our fixed cost. We'll see how many units we have to sell. 100 units. If we manage to sell 100 units, then we don't experience any losses. No profit as well. Because all the contribution we get from this 100 unit, we have to spend for our fixed cost. So this is what you call break-even units. How we calculated it? Fixed cost divided by unit contribution. Fixed cost divided by unit contribution. When we move to the break-even rupees, that means what should be our sales value in order to enjoy no profit no losses stage. So that in this scenario, if we get this example, our fixed cost is 6,000. That means we have to earn 6,000 contribution to cover the fixed cost. 6,000 contribution to cover the fixed cost. What is the ratio of contribution to sales? It is 60%. Then we are dividing this by 60%. 10,000 rupees. If we manage to earn 10,000 rupee income, our fixed cost will be fully covered. We will no longer face for losses, neither profit. Oh, there are certain business categories where we cannot exactly identify the units. Production, we cannot identify as unit. Let's say example, if you are doing a saloon, right? You can't say number of heads because the charge you get from a person is vary from the service he or she get. If it is a lady saloon, there are variety of services supply. So in business like in that nature are using this break-even point rupees, because everybody can say this is our total income. If we know the CS ratio, we can have a target. Our income should be this much to cover our fixed cost. So how we get this equation? Fixed cost divided by CS ratio, fixed cost divided by CS ratio. Okay, number 3, margin of safety. Margin of safety. Under the break-even point analysis, we discussed a point where we experience no profit, neither profit nor losses. But we don't do business to enjoy that state. No, we are doing businesses to enjoy profits. So margin of safety explains what is the room that you have to earn profit. What is the margin that you have to earn profit? That is what we call margin of safety. And this also we are expressing in two different ways. Margin of safety units, margin of safety rupees. Margin of safety units equation, sales units minus break-even point units. Margin of safety rupees, profit divided by CS ratio. These are the equations. Okay. Now I'm moving to the study pack again. Cost, volume, and profit analysis. Concepts. Contribution we have already discussed. Profit. Profit is total revenue minus total cost. The difference between the profit and contribution. When it comes to profit, we deduct all the cost, including fixed cost. When we are discussing about the contribution, we deduct only variable cost. And memorize at least 3 points, the difference between the profit and contribution. And the profit volume ratio or the contribution to sales ratio, CS ratio. We call it as CS ratio or PV ratio, profit volume ratio. Contributions divided by sales into 100. Then the break-even point. Break-even point is a point which there is no profit or losses. At this point, the total income of the company will equal to total cost. Profit and losses are 0. That means total contribution is equal to total fixed cost. So break-even cost point can be described in 2 ways. Break-even points in units, in rupees, the same equation. In units, fixed cost divided by contribution per unit. We don't need to multiply it by 100. Remove this. No need to multiply by 100. Right. Break-even point in rupees, fixed cost divided by profit volume ratio. And this is somewhat important. Memorize at least 3 points. Assumptions or limitations in break-even analysis, as well as advantages in break-even analysis. Minimum 3 points you should remember. At the end, we have discussed about the margin of safety. We have discussed about the margin of safety. I'm not going to discuss the exercise mentioned here, but you can have a screenshot and get your answers are also here. Those who don't have the study pack, you can get a screenshot. And short-term decision making. There can be a question in your examination from the short-term decision making. So I'm explaining few decision making types, right? But I'm not going in depth, because in every decision making type, what you have to do is calculate the relevant cost. So now already you know how to calculate the relevant cost, right? Let's get some examples. First one is making a decision of accepting or rejecting special order. Accepting or rejecting a special order. If somebody gives you a special order, and please, I mean, keep in your mind, this is a short-term decision making. That means a company or business which is already existed will have some short-term business opportunity. Then how we should react to that opportunity, we are discussing under this short-term decision making, right? So we will get a special order. We have to think whether we are accepting or rejecting it. How we do it? Get the relevant income, specific income from that order. Calculate the relevant cost. Then you will get the relevant profit. If the profit is plus, it is suitable to accept the order. If the profit is minus, we have to reject that order. Second type is decision making on production or purchasing. Some organizations, let's get an example. Let's say micro car company. They manufacture vehicles, but most of the parts they are importing or they are purchasing from outside. What if company feels whether we should manufacture this component inside the organization? Then they should take the decision whether they manufacture or purchase it. Which one is suitable? They have to take the decision. So those type of scenarios we are discussing under this production or purchasing. How we are going to calculate that? We are computing the relevance of the in-house production. How we do it? First, get the purchase price of supplier if the item is purchased from outside. We take it as an income. Why? We are saving that cost if we manufacture that item inside. Purchase cost from outside will be saved if we decided it to manufacture inside. So it is an income for this specific decision. But to get that income, we have to manufacture that item inside, right? In-house. So we have to bear a cost. Cost or the relevant cost of the in-house production. You have to minus it or deduct it. Then we will get profit or loss from the production. If there's a profit, we can produce. If there's a loss, we have to purchase it from outside. Okay. Then the final part, decision making when there are limiting factors. Decision making when there are limiting factors. Limiting factors, we are discussing this in two ways. Decision making when there is one limiting factor, and decision making when there are several limiting factors. First, we'll discuss about the decision making when there is one limiting factor. It's very easy. Two steps we have to follow. First step is deciding the sequence of production. From the maximum profit to least profit, we have to identify a sequence. How we are going to identify the sequence? First, we get the contribution of the product. First, we are getting the contribution of the product. It's like this. Let's say we have three products A, B, C. We'll take the contribution of each product. Let's say 100 rupees, 50 rupees, 80 rupees. Right. Then limited resource required for a 1 unit of production. We'll divide the contribution per unit from the limited resource usage and calculate the contribution earned for 1 unit of limiting factor. So when we move to the example, let's say the limiting factor is labor hours. To produce A, we need 2 labor hours. Sorry, let's say 4 hours. To produce B, we need 2 hours. To produce C, we need 4 hours. Then we are calculating contribution per labor hour. Contribution per unit is 100. We need 4 hours. That means 25 rupees is the per hour contribution. Let's say here as an example, only 1 hour. Contribution is 50, only need 1 hour, that means 50 rupees per hour. Contribution is 80, 4 hours, that means 20 rupees per hour. So when we observe the contribution per unit, we feel like A is more profitable, C is the next profitable one, B is the least profitable one. But the actual scenario is when we are facing a labor hour constraint, when we don't have adequate labor hours, what we have to do is we have to utilize our labor hour, which will give a maximum return to a labor hour. On that case, per hour profit maximized in B. So we give it, we rank them, we give number 1 ranking to product B. Even it gives the lowest contribution per unit, what we consider here is contribution per labor hour. It is the highest contribution per labor hour. So we are ranking it as 1. And this is 2, this is 3. This is how we identify the ranking. This is how we identify the ranking or production sequence. Then the second one is decision of production mix. Production mix is we are taking the maximum available quantity of the resource. We will take the maximum labor hour and start producing from sequence 1 to respective. First we produce 1. If we have an adequate resources to produce 1 to complete the demand of production 1, we will fully produce 1. And if there are any excess labor hours or excess resources, we'll move to product number 2. Even after supplying or meeting the demand of the product 2, if we have enough or if we have any further resources, we will move to product number 3. Likewise, until we fully finished our resources, we are keep on manufacturing. So when we move to our example, let's say we have 4,000 labor hours. First, produce B. Let's say market demand for B is 2000 unit. 2000 unit, we need 1 labor hour. So 2000 labor hours we need. Remaining hours are 2000 after producing B. So the second product is product A. And we are starting produce product A. Market is how many hours we need? 4 hours we need. Market is asking 400 unit. 400 unit into 4, 1600 hours we need to produce A. Only 400 hours are remaining. Product C, market is asking 1000 unit, demand is 1000 unit, but in this case we cannot produce product C 1000 because we don't have adequate or enough labor hours remain. So from this 400 hours, we need 4 hours per unit. Only we can manufacture 100 units. For these 100 units, we need this 400 labor hours. So labor hours are finished. So finally, production estimation, we can have A, we can produce 400 unit. B, we can produce 2000 unit. C, only 100 units. This is the best production mix. So this is how we take decisions under one limiting factor scenario. Right. If we move to a limiting factors, several limiting factors. In this case, we have to apply this information into a mathematical module. We call it as a linear programming model. So linear programming model, two steps we have to follow: planning the linear programming model and solving the linear programming model. Under the planning the linear programming model, we have to identify the decision variables. We have to recognize the objective functions, and we have to identify the constraints we have to reach our objective. When it comes to solving linear programming model, there are two methods which are called graphical method and simplex method. But luckily in your examination, simplex method we don't test. So only graphical method is tested. Under this graphical method, corner point evaluation method and ISO profit line method, we can use either method to identify the best production mix, but most of the time we are identifying that corner point evaluation method, right? Corner point evaluation method. Just quickly write down or get a snap of this exercise. It says Superman Limited is producing two products called X and Y. Sales prices and the cost data are as follows: price of X and Y, X 120, Y 80, direct material cost X 50, Y 40, labor cost X 20, Y 15, variable cost X 10, Y 5. Material required to produce X and Y are 3 and 2 respectively. Labor hours required for the production of one unit is 2 hours and 3 hours respectively. Available quantities of raw materials and labor hours are 300 and 240 respectively. That means maximum labor hour, so maximum raw material we have is 300 unit, labor hours we have 240 units. Maximum demand for X is 90 units. That means we cannot produce unit X more than 90 because there's no demand after that. You are required to develop a linear programming model for this problem, reflect the feasibility area by using the graphical method, find out the maximum production mix to maximize the contribution. If the demand increases up to 100 units, it is affected to the optimal solution? Okay, we'll see. First, what we have to do is plot the linear programming model. In this model, we have to identify decision variables, plotting the objective functions, and identification of the constraint we have to do. Okay. So decision variable. What do you mean decision variable is? What is the decision we expecting to take at the end? What is the decision in this example? How many number of A units and B units we have to produce? How many number of A units and B units? Sorry, how many number of X units and Y units we have to produce? That is the decision we are expecting. We don't know actually now how many units we have to produce. We have to find out. We have to find out by giving the data to our model. So we identify this end result as a variable. We say, let's assume number of unit produced as X are capital A. Since we don't know the exact number, we can't put a number. So we are putting a letter. Number of units from X is A. And let's assume number of units from Y is B. These are the decision variables. So we have to then this should not be A and B. Whatever the number you whatever the letter you like, you can put it here. Your first name, first letter of your name, first letter of your first name, first letter of your second name, or first letter of your first name, first letter of your boyfriend or girlfriend name. Whatever the letter you can put there, and that will be a decision variable. Then second thing, we have to identify the objective function. What is our objective? Not to have a girlfriend or boyfriend. Our objective is to maximize the profit or the contribution here. We'll say max Z. Max Z. Z means profit. Is equal. We'll quickly go back to study back a question and see what is the contribution. Come to the question. Unit number X, sales price is 120. Variable cost 50, 20, 10. That means altogether 80. If we deduct 80 from this 120, we have 40 rupees, no? We have 40 rupees contribution for X. What about Y? Sales price is 80, cost 40, 55, 60. 20 rupees. 40 rupees is the contribution from X, 20 rupees is the contribution from Y. So 40 rupees is the contribution from X. How many units you are producing? A number of units. So 40 into A, 40A is the total contribution from X, plus 20 is the unit contribution for Y. How many units we are producing? B number of units. That means 20 into B, 20B is the total contribution from B. This is our objective function. This is our objective function. So you can see the answer here. Let's assume that the number of units produced from X and Y are A and B respectively. Put that word as well, right? Objective function, maximum of profit, max Z, is equal 40A plus 20B. Then constraint. It says we only have 300 unit of raw materials. Then there's a constraint. We cannot find more than 300 unit of raw material. So we have to play in between 300 or maximum 300. So what is the requirement? Material 3 for x, 2 for y. So we are preparing a function called 3 for x. No, we are producing a number of units from x. That means 3 into a. 3a is total requirement of the material for production x. 2 units for production y. 1 unit of y. How many units we are producing? B number of units. That means 2b is the total requirement for product y. That means 3a plus 2b is the total raw material requirement, which can be maximum of 300, equal or less than 300. That is the constraint, material constraint. When it move to labor, 2 units to x, 3 unit for y. So 2a plus 3b less than or equal maximum 240 we have. 240 we have. Demand 90 units from x. Maximum manufacturing is 90 units. That means we are manufacturing a units from x less than or equal to 90. This is third constraint. And all our limiting factors we have identified. But this is a mathematical module. It don't have any sense. So we have to input everything. So we have to tell this module, don't give any answer to A and B, a negative answer. Because in practically, we cannot manufacture negative amounts. We cannot manufacture negative amounts. If you are running a garment factory, what if somebody says manufacture minus 200 units? How can you do that? Can't do, no. You can either manufacture, I not either manufacture zero, that means no any manufacturing, or else manufacture plus amount. You can't manufacture minus amount. So we have to tell this module we cannot do minus figures. It is we call as constant or zero constraint. Constant constraint or zero constraint. That means we say A or B should be greater than or equal to 0. It can be 0 or a greater value, cannot be lesser value. So we have to put this constraint at the end. Then we have identify the decision variables, plot the objective functions, identify the constraints. Now we are going to solve it using graphical method. That means in a graph, we have to draw this constraint line because these constraints are our boundaries. These constraints are our boundaries. How we are going to draw these lines? We'll take one by one. Let's get the material constraint. It says 3a plus 2b less than or equal to 300. The maximum point is 3a plus 2b equals to 300. At that point, we are identifying two points to draw this graph. How? We are assuming what if a equals 0? That means when we are not manufacturing anything from x. If a equals 0, 3a is 0, that means 2b equal 300. That means 1b equal 150. here. A0, B 150. Again, we are assuming what if B equals 0? What if B equals 0? Then 2B equals 0. 2 into 0 is 0. That means 3A equal 300. A equal 100. Likewise, we have identified the points and draw these lines. In this case, this is our optimal solution from P to Q, Q to R, R to S. This is our optimal solution area. Our solution will be on this line, on this boundary, or in between this area. But we have to identify it. How we are going to identify it? First, we are evaluating these corner points P, Q, R, and S. Evaluating means we have to identify the profit amount at these points. Our profit function is objective function. 40A plus 20B will give us our contribution. So 40A plus 20B. We are substituting the figure point at this point P. Let's get this point P. A is 0. 0 into 40 is 0. B is 80. 80 into 20, 1600. Total profit is 1600. At point Q, it is difficult for us to tell how much is the A and B by using this graph. But we can say this point Q comes of the intersect of number 1 line and number 2 line. So point at the point Q, first line equation is 3A plus 2B equal 300. Second line equation is 2A plus 3B equal 240. We say these two are simultaneous equations because why? At this point, these two are intersecting. So we'll get the answer from the calculator. Input these data to simultaneous equation and solve the simultaneous equation. You will get the A value as X, B value as Y, 84 and 24. Then we are substituting it to here and get the profit figure. At the point R also the same. It's a bit difficult for us to identify. Only A we can say it is 90 because of this A equals 90 line. But B we have to identify by substituting A equal 90 to line 1. It comes B 50. Then profit is 3900. Point S is very easy. S 90 unit from A, 0 unit from B, profit is 3600. So at this from these four points, the maximum profit we enjoy from 3900 from point R. So we say appropriate production mix is 90 units and 15 units. 90 unit and 15 units. 90 unit from production X, 15 units from production Y. That's how we are solving this graphical method, this problem using this graphical method and corner point evaluation method. In this question, the final question is, if the demand increases up to 100 units, if it affects the final solution, demand increasing 100 unit means point S is shifting from here to here. A equals 90 line is shifting right to A equals 100. Then our corner points P, Q, R is no more there, only S is there. But S, the figure is changing. Now it's 100, 100 into 4, 44,000. Yes, the answer will change. It comes to 4,000, and new production mix is 100 unit from X and no unit from Y. Okay. From this, I'm winding up the sessions today, and thank you very much for being with us. Hope you will have a good result from upcoming examination, and hope this quick session will give you benefits to face your examination. And thank you very much. Thank you, everybody.